My name is Michaela Fox. I'm a partner in the professional indemnity team at Waitmans, specialising in solicitors' professional indemnity. I'm joined today by my fellow partner, James Moore, who is a partner in the restructuring and insolvency team at Waitmans, specialising in all aspects of corporate and personal insolvency, with particular expertise in the professional services sector. Today, James and I are going to be looking at how the pandemic has impacted on solicitors' firms, specifically on the cash flow and the liquidity of some firms, particularly those operating at the volume end of the market. We're also going to discuss what options there are for what seems like the inevitable insolvency of some practices. Undoubtedly, the current concern for most firms is liquidity. As press coverage over recent weeks has highlighted, whilst the pandemic has adversely affected all firms, there is a clear divergence between high street practitioners, bulk conveyancers, and those that rely on legal aid work, and boutique firms or larger firms provide a mixture of services, not all of which have been hit by the downturn in trade. In terms of the latter, last month, international firm Osborne Clarke announced that partners and staff would have to take an 11-month pay cut as the impact of the pandemic continued to take hold, and that staff had been offered a number of voluntary options, including part-time paid sabbaticals, early retirement, a reduction in hours, or moving to job share. Then on the 12th of June, it was reported in the legal press that Reed Smith and Trowers and Hamlin were cutting NQ positions, that Herbert Smith Freehills had offered trainees £8,000 to defer taking up their contracts, set to start in 2021. Whilst then it is impossible to predict the full extent of the damage to the profession caused by the crisis and how quickly and to what extent firms will bounce back as lockdown measures start to ease and the economy gets back on its feet, the emerging picture is that for some firms, cash flow pressures will be short-term and may be satisfactorily addressed by taking advantage of government initiatives. Initiatives such as the wage subsidies available for furloughed workers, deferred income tax payments and the self-assessment, the coronavirus business interruption loan scheme, and the COVID-19 corporate financing facility, which provides assistance to large businesses for the purchase of their short-term debt. However, for other firms, i.e. those that were already operating on the smallest margins, the drop-off in work, the inability to work up cases to the point of recovery, and, I venture to suggest, the almost inevitable increase in the cost of professional indemnity insurance, as insurers tighten their belts, will toll the death knell for the practices. Legal aid, personal injury, and conveyancing firms have all been identified as at risk owing to the drop-off in work and the specific funding models that they operate. The Law Management Section Financial Benchmarking Survey 2020 offers a useful insight into the financial health of a good proportion of the profession prior to the onset of the coronavirus crisis. 214 small and medium firms across England and Wales participated in the survey, which analysed the financial performance of the participants in the previous two accounting periods. In respect of the 2020 survey, 60% of the data provided was based on information up to the end of March or end of April 2019. On the whole, the findings were positive, with most firms reporting an increase in fees and a degree of confidence about the future. However, it wasn't all good news. Some firms were struggling with rising wage bills and increases in other fixed cost overheads, and the consequential squeeze on net profit. The survey also highlighted a not insignificant percentage of cases where partners' drawings exceeded profits for 2 years and borrowing was in excess of the firm's current assets. Fast forward 12 months, and I doubt few firms would report the same level of confidence in the market. Indeed, if the results of a recent Law Society survey are indicative, then almost 3/4 of small high street practitioners do not see a future beyond the end of 2020. The Law Society survey was sent to 7,958 small firms. Small firms are defined as those with 4 or fewer partners, including sole practitioners. In total, 774 responses were received. Of those responses, 71% said that they believe they may have to close their doors in the next 6 months as a result of the crisis. Of the results, Law Society President Simon Davies commented that there's widespread concern over liquidity as firms face a dramatic plunge in income, and also that the shock to the legal services sector has been sudden and severe with work falling away. Despite the plight of small firms has also been highlighted the limitations of government support, with professional firms specifically excluded from some support that is available to other small businesses. An example would include the fact that professional firms are still expected to pay business rates through this period whilst their business rooms stand empty and their workers dropped off. This has led to the Law Society to renew its appeal for further help with cash flow through the Standard Monthly Payment Scheme, together with business rate relief. Without change, the Society's warned that the legal aid sector is facing collapse. Chancery Lane also wants previous legal aid cuts reversed and the restarting of work on criminal and civil sustainability. They say to give firms reason to believe that there is a better future worth struggling on for. However, despite the best efforts of the Law Society, there will be casualties from this crisis. The jury is still out on whether the recent acquisition by Taylor Rose of high street firm Macmillan Williams was the inevitable consequence of the coronavirus crisis on the conveyancing sector or due to the firm's heavy reliance on external finance. The truth probably lies in a combination of factors, by no means unique to Macmillan Williams. According to a recent commentary in the Gazette, an analysis of 10 firms just behind Macmillan Williams in terms of revenue shows that they collectively owed £94.4 million as of April 2019, two-thirds of which was due within 1 year. Now, such debt might have been manageable in normal times, but it isn't now. And it's possibly no surprise that financial advisors, Consumer, who are involved in the pre-pack sale of the firm, think this will be the first of many pre-pack administrations to come. Indeed, Andrew Hosking, a partner at Consumer, estimates that 250 firms nationally may be restructured or forced to merge because of the crisis. In more recent times, pre-pack administration sales have, save perhaps in the case of the SRA, grown in popularity. Owing to regulatory restrictions, it's simply not practical to run a solicitor's practice whilst in administration, so pre-pack administration sales are seen as a way of dealing with an insolvent practice and avoiding instant closure or intervention. From the firm's point of view, intervention represents the worst of all worlds. Intervention essentially freezes the firm's accounts and assets. From the regulator's point of view, the point of view of the SRA, their chief concern is the client's interests and assets, including their confidential information, are safeguarded. So when a firm is intervened, the SRA will appoint agents whose job is to take control of the business, transfer the money, documents and files away from the firm for safekeeping. In a pre-pack administration, the law firm is sold as a going concern on terms arranged and agreed prior to the administration. And as the business client information and assets are transferred to the acquiring law firm, the SRA is usually satisfied. Thus, whilst the SRA's official line is that they do not approve of pre-pack sales, provided the disposing firm can demonstrate compliance with the regulatory requirements, the SRA will not buy the sale. So far, so straightforward. However, insolvent law firms can throw up a number of unique challenges for professional advisors, not least due to the close scrutiny maintained by the SRA throughout the process. James, as someone who's at the coalface, I'm sure what I've said chances your experience of the issues faced by insolvent law firms.
Yes, thank you, Michaela. As introduced earlier, my name is James Moore. I'm a partner in the restructuring and insolvency team here at Wakeman, specialising in all aspects of corporate and personal insolvency, with particular expertise in financial services, professional services and sports insolvency. As Michaela touched on, insolvencies of law firms are unique in the issues they pose for insolvency practitioners when considering taking an appointment of an insolvent law firm. Firstly, the regulatory and statutory regime make a number of insolvency and restructuring processes very difficult to effect. As an example, law firms are rarely able to implement a successful voluntary arrangement, as the event of calling creditors and member meetings to consider a proposal will often stir the SRA to intervene, and in doing so take a statutory charge under the Solicitors Act over all the firm's practice monies, and further, in doing so, starving the firm of any ability to fund a CVA. This obstacle to an insolvency practitioner in seeking to rescue a practice is particularly difficult when considering a creditor's voluntary liquidation, which requires notices to be sent to all creditors to call a meeting, and in doing so, potentially instigate an SRA intervention, again starving the office holder of monies vested in the company. The issue is that the SRA's priority and primary reason for intervention is the sacrosanct nature in which they seek to protect client interests as opposed to those of creditors, for which the insolvency practitioner is there to protect. What is going to be interesting in the coming months is how the Corporate Insolvency and Governance Bill interplays with the Solicitors Act, and once it's passed into statute. There's long since been a tension between the Insolvency Act 1986 and the Solicitors Act 1974 in terms of the interests of clients versus creditors. The Corporate Insolvency and Governance Bill will introduce two new tools to the insolvency toolkit, one of which, the restructuring moratorium, is likely to play an important role in law firm insolvencies going forward. Whilst the concept of an insolvency moratorium is not new, the new restructuring moratorium does allow an opportunity for the insolvency practitioner to secure the office account without need for notice on anyone, which can in turn provide a moratorium over all enforcement action against company assets for up to 40 business days without creditor intervention. Whilst the SRA retain the right to intervene at any time, it is unclear how this interplays with a moratorium on all enforcement actions against company assets. Indeed, the restructuring moratorium prevents enforcement of security without court permission for up to 12 months. This could be an important game changer for insolvencies of law firms, as it could allow administrators and liquidators the luxury of being able to fund an insolvency process and also fund investigations into partners and directors. One of the main issues around SRA intervention is that they starve the firm of cash in the pursuit of preserving client files and monies, often leaving no funds behind to investigate the perpetrators. Whilst the SRA have the power to pursue partners and directors for the cost of the intervention, often the easier target is simply to fund those costs from the office account, and in doing so drain the insolvency officer holder of any potential funds with which to hold partners to account. The other important factor to note is that the SRA are far more involved in law firm insolvencies than most other regulatory bodies, such as the FCA. The FCA in many ways has far more far-reaching powers than the SRA with regards to insolvencies of its members, but it usually leaves the company and insolvency practitioner to conduct the insolvency, with the FCA taking in more close but passive involvement, essentially leaving the IP to administer the repatriation of client assets. In addition to these complications of law firms' insolvencies, there's the added fact that law firms are structured differently to most businesses. They're largely not incorporated as limited companies, often run as partnerships and increasingly as LLPs. This in itself creates slightly different procedural steps. Whilst most insolvency procedures apply to LLPs as they do to limited companies, the LLP agreement will often involve more complicated steps through each agreement to put the LLP into a process, which in turn, by which time that insolvency process is commenced, the SRA may well have commenced intervention proceedings. Finally, almost invariably, the main asset of any law firm is its work in progress and debtors. This can, by its very nature, cause difficulties to fund an insolvency, often, particularly with firms who conduct a large proportion of conditional fee arrangement work. The nature of the debtors are often difficult to value, and in the current climate, that valuation is proving harder to put a figure on. What is key to an insolvency of any law firm is managing the different stakeholders' interests, keeping an open dialogue and understanding with the SRA, and crucially trying to uphold creditor interests in the wake of fierce pressure from the SRA to allocate all resources to the protection of client monies and matters. If a dialogue can be maintained with the SRA to ensure that client interests are maintained, it is possible that restructuring solution can be achieved without the need for formal insolvency or intervention through a transfer of the business and assets.
Thanks, James. That's all very interesting. I think that brings our podcast to an end for today. I hope you found it useful. All that remains for me to say is that each firm's situation is different and that there is no substitute for tailored professional advice. If you are interested in exploring any of the issues in the podcast further, I'm sure I speak for James when I say that we would be more than happy to set up a call with you and discuss how we can help you and your business. Thanks for listening. Stay safe.